Tax avoidance by multinational corporations has become a topic of concern in our globalized economy. It raises moral and ethical concerns because it leads to governments losing billions in revenue, which could otherwise be used to provide beneficial services and infrastructure to communities which improve people's quality of life. It has become such a widespread problem that the G20 and OECD have developed strategies to specifically target profit shifting across borders by establishing the Global Forum on Transparency and Exchange for Information for Tax Purposes. Our presentation will discuss how companies are able to avoid paying tax through transfer pricing and examine the pros and cons of dealing with this issue through the proposal of having companies being taxed on the consolidated group level rather than the legal entity level. One of the ways in which taxation differences between countries are exploited is through transfer pricing. So what is transfer pricing? It is when two subsidiaries which belong to the same group trade with each other at a price which is agreed upon by both parties. If Company A and Company B are subsidiaries of parent X, the price at which Company A can purchase goods from Company B is called the transfer price. Transfer pricing is not inherently a detrimental practice, and in fact is often necessary for entities to establish how to trade with each other. However, transfer pricing can result in profit shifting. This is where a multinational corporation is able to shift profits out of the country that it operates in and into tax havens, which is another jurisdiction with different tax laws that the company can bypass and utilize to help them pay less tax. They can do this by setting an artificially low transfer price, which will earn them lower profits and therefore a lower tax. The company is able to claim that their products and essentially intellectual property are conceived in the tax haven. It can use a subsidiary in the tax haven to direct costs to other countries and set an artificially high transfer price, where there will be a larger profit generated by the subsidiary in the tax haven. As a result, the multinational company that has shifted profits into the tax haven can underreport the profit that is made in the jurisdiction, which will typically have a much lower corporate tax rate if it has one at all, while having very high profits in the tax haven, which comes from selling to other subsidiaries. While high profits would typically be taxed more, the fact that they are in a tax haven means that they will pay little or no tax. Thus, the multinational company can exploit tax loopholes and drastically reduce their tax bill.
One example of companies avoiding huge tax liabilities by using tax loopholes regarding international subsidiaries is Google. Google established its European headquarters, Google Ireland Holdings Limited, in Ireland in 2003, and was subsequently reported to have recorded its revenue made by other European branches, since Ireland has a relatively lenient tax law system, and the Irish corporate tax is lower than that of other European countries. This means that Google's other European-based companies recorded less income than what they actually earned and declared fewer profits to reduce their local tax payables, therefore increasing their overall profits after tax. Taking Google's primary revenue earned by providing advertising as an example, Google's European customers would sign contracts with the Irish company to receive their services provided in whichever European country. With these tax avoidance schemes, in 2011, Google Britain declared sales of £396, while they actually generated more than £4 billion of income and paid approximately £6 million worth of corporation taxes, which is far less than what it should be, considering the original net income was 100 million more than what they recorded in their annual report. Other than Google Ireland Holdings Unlimited in Ireland, later in 2011, the company also set up another Google Ireland Unlimited located in Bermuda as a shell subsidiary to the Irish company to carry out their double Irish strategy. The reason why Bermuda was chosen is obvious. It is one of the tax havens that multinational companies like Google can lawfully go beyond the reach of their original jurisdiction's tax authorities, and therefore being able to transfer their intellectual property patents and sales revenue to Bermuda without being charged with taxes. Therefore, not satisfied with paying fewer taxes, Google moved a large portion of their earnings recorded in Ireland further to the Bermudan subsidiary to avoid taxes of that part entirely. They claimed that from the years between 2004 and 2011, they've only collected 24.8 billion US dollars outside of the US, while an American advocacy group reported that they've in fact accumulated 1.5 trillion US dollars offshore and have evaded billions of their tax obligations. Double Irish was committed by Google for years until 2020, when practices like this were brought to the public attention. In response to these tax avoidance schemes that breach the public interest obligations and violate accounting ethics, both the US and Irish governments amended their corporate tax system by introducing new regulations targeted at administering similar situations. However, undoubtedly there is more to be done to ensure there are comprehensive regulations against tax avoidance, which further brings to the necessity of this proposal and the question of why it is essential.
I will explain why the proposal, which is cooperation, should be taxed on the consolidated group level instead of the legal entity level, might help discourage transfer pricing tax avoidance. If the proposal is not implemented, multinational companies that are composed of many subsidiary entities are taxed by using the assumption as if they were independent companies. This then leads to a transfer pricing tax avoidance, as the company wants to pay taxes as lower as possible. Basically, transfer pricing or the arm's length price occurs when a multinational company, for example, comprises of two companies, Company A, located in high tax country, traded with Company B, located in low tax country. The trade price of those two companies should be set the same as they would be if two non-associated companies traded with each other. However, the arm's length price is difficult to determine, and thus, they can adjust the price in order to reduce their tax liability by shifting profits from high tax to low tax countries. On the other hand, if the proposal is implemented, which means the multinational company is taxed by using consolidated taxation system, tax authorities will look at the multinational company as the group consisting of all its subsidiaries, instead of handling the entities individually. The profit of the multinational company as the whole is then allocated to each entity's countries based on the level of economic activity occurring. This indicating that with or without profit transfer between entities, the multinational company's profit will be the same. And thus, multinational companies are unable to reduce their tax liability through transfer pricing schemes. Let's look at these scenarios for comparison. Let's say there is a multinational company comprising of two entities of Company A and B. Company A manufactures shirts and sell them to Company B. Company A located in Australia with 30% tax level, and Company B located in Monaco with 0% tax level. So the scenario one is if the proposal is not implemented. When the proposal is not implemented, it means that when multinational companies are taxed using independent entities assumption. So consider the manufacturing cost of 1,000 shirts is $6,000. If a company A can sell all of those 1,000 shirts to Company C for $9,000 and get $3,000 as profit, this company needs to pay $900 tax in Australia. But if the Company A sell all of those 1,000 shirts to its entities, which is Company B, for only $7,000, they only gain $1,000 in profit, but they only need to pay $300 tax in Australia. And then Company B then can sell those 1,000 shirts to Company C for $9,000, which means they can get $2,000 and pay no tax in Monaco. On the other hand, if the proposal is implemented, which means that the company's profit as a whole is $4,000. And if 80% of its economic activity occurs in Company A, Then Australia tax authorities have the right to apply tax to $3,200 of the multinational profit. The company ends up paying $960 tax in Australia, which is $60 higher than in the first scenario. In conclusion, the transfer price tax avoidance can be effectively prevented if the proposal is implemented, as the company will be taxed based on the perspective of a whole group.
So I'll be briefly discussing the difficulties in implementing a consolidated group level tax system. There are many practical difficulties that make taxing corporations on the consolidated group level very difficult. Most notably are that the elements of the tax system must be adopted consistently on a global basis. The first element is what exactly constitutes a consolidated group. Under current accounting rules, company accounts are consolidated into a group when more than 50% of the company shares are owned by the parent, i.e. the parent company holds majority stake. Under this definition, there could be schemes where multinational corporations set up joint ventures and allow profits to be accumulated in a subsidiary. This infers that any joint venture would also need to be proportionally consolidated and included when calculating the tax base. When creating the tax system, extra care needs to be taken when considering what exactly makes a consolidated group to prevent such loopholes. The second element is the allocation of tax revenue across multiple international jurisdictions. How exactly do we allocate profits to be taxed across multiple international jurisdictions? The concept of distributing tax based on economic activity has already been mentioned in this presentation, where it has been proposed that profit will be taxed based on where economic activity is taking place, not where profits are being reported. For example, this multinational corporation has a tax base of $100. In A, there's an economic activity of 50%. $50 will hence be taxed here. A local tax rate of 21% would then be applied to the $50. Hence, the corporation pays $10.50 in tax to jurisdiction A. Now, there are many problems that come with this proposal. Most notably, a formula will need to be derived for the allocation of profits that most accurately fits the real productive economic activity taking place in each jurisdiction. What exactly constitutes an economic activity that generates profit? What part of a corporation's activity dictates its profits? For the tax system to be effective, there needs to be a global agreement on how economic activity and its value and percentages are derived. Finally, not everyone will agree on this economic activity method of distributing tax revenue. It is inconceivable that a global consensus could be agreed upon to how profits and tax revenue should be allocated between jurisdictions located in each international country. For example, each jurisdiction A, B, and C will inevitably develop their own formula that maximizes this value, their share of the global profits that they can then tax. And finally, the final element is there needs to be an internationally agreed upon tax accounting standard in determining each multinational corporation's tax base. For example, say A thinks that this multinational corporation has a tax base of $100, but B could think that this multinational corporation has a tax base of $80, and jurisdiction C could report that this multinational corporation has a tax base of $110. In order for the tax system to be effective, there needs to be an internationally agreed upon tax accounting standard to determine each multinational corporation tax base consistently. To end off this presentation, I would like to say that the idea of taxing multinational corporations on a group level is not a new concept, but the main reason it has not been implemented yet is due to the size and difficulty of the task. A global consensus on the tax system would require enormous political, administrative complexity and cooperation, which is not impossible, but unrealistic. Thank you for listening to this presentation.